Hello everyone, I'm Leela Prabhu and I'm from the Bodhi Academy. So today we'll start with the solution of GOA Board 2019 economics paper. And first of all we are going to discuss all the important questions for the with regards to your board exams. Okay, we'll discuss the MCQs and then directly we'll move to the big question answers of this. And okay, so whenever you start writing the economics paper, you have to remember that you have to start with the introduction first. If the question is for more than 5 marks uh, or it is for 8 marks, then you have to start with the introduction. Then with the if the assumptions are there for the particular questions, then you have to write the assumptions, draw the diagram, draw the schedule in the sense the table whatever is given, and then you have to conclude. Okay, so this is how you write the economics paper. So this is 2019 paper. Maximum marks is 80. So the first question, we'll move to the first question. So the first one is a diagrammatic presentation showing the different combination of two commodities between which a consumer is indifferent to. So it is indifference curve. Okay. Then if the price of mobile phone decreases, the demand for SIM cards will, what will happen to the demand if the price of mobile phone decreases? Okay, the demand for SIM card will increase. And the first one was indifference curve. Then a table showing different quantities of a commodity that all the buyers in the market are ready to buy at different prices is called as a table. A table means a schedule. Okay, so here all the buyers in the market are ready to buy at different prices. So it is market demand schedule. Then next, in the state of Punjab, a crop disease has reduced the yield of wheat. The supply of wheat will be what? So a crop disease, it has reduced the yield of wheat. Okay, so the supply of wheat, what will happen to the supply of wheat? It will remain constant. It will expand, increase or decrease. So it will decrease. Then the functional relation between physical input and physical output of a commodity is known as the production function. So this is important. Functional relation between the physical input and the physical output of a commodity is known as the production function. Okay, I hope that I am audible and the screen is also visible. Okay, then the next question is a consumer can buy 10 units of good. Question number 6. A consumer can buy 10 units of good 1 and 20 units of good 2 if she spends her entire income if the prices of the two goods are 10 per unit and 20 per unit. Calculate the income of the consumer. So now here we have to find out how much is the income of the consumer. Okay, income of the consumer. Income of the consumer we have to find out. So a consumer can buy 10 units of good 1 and 20 units of good 2 if she spends her entire income. So, and the prices of both the goods are given, that is good 1 is rupees 10, good 2 is rupees 20. Calculate the income of the consumer, they have said. Okay, so now when we have to calculate the income income of the consumer. What we have to remember is we have to remember the equation. Okay, so P1 x1 plus P2 x2 is equal to M. Okay, M is for the total income. So P1, now P1 is for this price, the good one. Okay, so good one is 10 and the price which is given is 10 per unit. So a consumer can buy 10 units of good one at rupees 10. So how will denote 10 multiplied by 10 plus good 2 is 20 multiplied by how much is the price? 20. So 20 multiplied by 20 is equal to M. So this will give us 100 plus this is 400 is equal to M. So total is 500 is equal to M. So 500 is what? It is the income of the consumer. So I have to write down income of the consumer. Income of the consumer is rupees 500. Okay. So the income of the consumer is 500. Then next question. Calculate the price elasticity. So quickly we'll do with the whatever the basic things are there, and then we'll move to the question answers. So here it is given, calculate the price elasticity of demand when quantity demanded increases from 100 units to 150 units due to a 5% fall in price of the commodity. Okay, so question number 7. So price elasticity of demand, how do we calculate? Elasticity of demand is equal to elasticity of demand is equal to percentage change in quantity demanded divided by percentage change in price. Okay. So how much is the quantity demand they have given? Calculate the price elasticity of demand when quantity demanded increases from 100 unit to 150 units. So here we have to take the difference. So how much is the difference? 50. Okay, because it is 100 minus 150. So it is increased by 50 divided by 100 multiplied by 100. So this is equal to 50. Okay, then due to a 5% fall in price of the commodity, 5% fall in price of the commodity. So here directly they have given the percentage change in price. So percentage change in price is 5%. Okay, so percentage change in price is 5%. So we got 50 divided by how much is the percentage change? 5%. So it should be 10. So price elasticity of demand we got it as 10. Okay, then So it's better if I move to the questions first, and then we'll discuss the 1 mark questions, because this carries 3 marks and then carries 5 marks. Then the next question, what is meant by the following? Okay, the first one is normal goods. Now what do you mean by normal goods? Normal goods, so normal goods are those goods whose demand increases with the rise in income. So you have to remember this as demand increases with a rise in income and decreases with a fall in income, and decreases with a fall in income. So this is called as normal goods. Okay, then so normal goods are those goods whose demand increases with the as the income of the consumer rises. Okay, their demand will increase with the and decrease with the fall in income. So this is vice versa. Then inferior goods are those whose demand decreases inferior goods are those inferior goods are those goods whose demand decreases with a rise in income, with a rise in income, and increases with the fall in income, and increases with a falling income. Okay, so this is called as inferior goods. So inferior goods are those goods whose demand decreases, so whose demand decreases with a just a second. Okay. So inferior goods are those goods whose demand decreases with a rise in income and increases with a fall in income. So these are called as inferior goods. Then we have got substitute goods. Now substitute goods question number 10 third. Okay, substitute goods are your let's say Pepsi and Coca-Cola. Okay, example which can be substituted for each other. So these are substitute goods. So similar products that a customer may use for the some other purpose. Okay, these are called as substitute goods. Then next, what is meant by the following? So sometimes this question can be both the question can be asked for or, like here how they have asked. So any one you have to answer, or then what is meant by the following? So cartel, this sometimes comes as a MCQ type of question. So cartel is nothing but a formal agreement between producers, okay, to avoid the competition. So cartel is a formal agreement between the producers, or between the firms, we can say, to avoid. So they make a formal agreement, okay, so that they can avoid the competition, to avoid the competition and some conflicts, okay. Or we can say conflicts. So this is how you have to remember cartel, and this they can ask this as a MCQ type of question. Then equilibrium price. The next is equilibrium price. I'll write the answer over here for equilibrium price. So equilibrium price is that maximum price, okay, the maximum the profit which they expect. So okay, here I will write equilibrium. Question number 11. Okay, so here a producer tries to strike some maximum price, okay, maximum profit. Profit maximization. Here they deal here they deal with the profit maximization. Okay, so this is called as equilibrium price. Then monopoly. Monopoly, as we know, is a single seller. So these three questions are for 1 marks. Single seller who has got a large number of buyers and he takes his own risks. Okay, so monopoly is a single seller and there is no product differentiation because he sells only one single product. Okay, so you can say that there is no product differentiation, no product differentiation. Okay, so this is called as monopoly. Then question number 12. Explain the three determinants of supply. Which are the three determinants of supply? Determinants of supply. So here they have asked this question for 3 marks. So three determinants of supply are, the first one is price of commodity, price of price of commodity. So there is a direct relation. So when we have to understand with regards to price of commodity, you have to remember that there is a direct relation between price of a commodity and its quantity supplied. Okay, so direct relation between price of commodity and quantity supplied Okay, so there is a direct relationship between price of commodity and quantity supplied. um, at a higher price, so what will happen? At a higher price, the producer will produce more, okay, and they are going to supply great quantities. So this is what a price of commodity is with regards to determinant of supply. Then second one is technology. So supply, determinants of supply is also based on technology. Okay, it also depends on the use of technology. So with the introduction of new technology, the cost of production, what will happen? It will go down. So now if the particular producer is using the outdated technology, what will happen? That outdated technology is not going to give them a good returns, or they are not going to give them a good produce good products, or they are not able to produce the good at a efficient time. Okay, so technology is also very much important over here. So here producer, they have to improve its own technology. Okay, so that this will maximize its production, and they are going to supply more in the market. Okay, so technology is one of the main factor that we require in the production of any product. So if they are going to use some outdated technology, then it is of no use, because it is going to consume more time. So here you have to remember, outdated technology is going to will take more time. So they have to switch to the new. So switching to the new technology, so switching to the newer technology will supply more in the market. Okay, then the third one is number of firms in the industry. So determinants of supply, it also depends on how many number of industries are there. Okay, number of firms. So supply also depends on how many number of firms are there in the market. So market supply for commodity depends upon the number of firms. Okay, so let's suppose there are more number of firms. There are more number of firms in the market. Then there will be an increase in the market supply. No, so more firms will lead to the increase in market supply. Then if there are less firm, then decrease in the market supply. So this is how you have to remember number of firms. Okay, so we are so determinants of supply includes price of commodity, technology, and number of firms in the industry. Okay, so price of commodity got direct relation between price of commodity and a quantity supplied. Technology, we have to use a new technology. Outdated technology will take more time to supply in the market. Number of firms, as there are more firms in the market, there will be an increase in the market supply. As there are less firm in the market, there will be a decrease in the market supply. Okay, then we'll move to the next question. What is meant by the following terms? So there are two options given over here: total cost, average cost, marginal cost, and they have also given extension of supply, unit elastic supply, relatively elastic supply. So I'll do the first one, that is total cost, average cost, and the marginal cost. So okay, question number 13, first one. Question number 13. First, total cost. So now, total cost includes it is a sum of total fixed cost and the variable cost. Okay, so total cost includes total of fixed cost and the variable cost. Then the another question, so this is total cost, so which includes the fixed and the variable cost. It is a sum total of fixed cost, we can say a sum total of fixed cost and the variable cost. Okay, then average cost, second one is average cost. So it is a total amount of all production so it is a total amount of all production cost divide, since it is a average cost, we have to divide, we have to find out how much is the average, so divided by the quantity of output produced. So this is called as average cost. Then the next we have is marginal cost. The third one is so marginal cost, the word marginal is the addition to something. Okay, so it is the addition made. It is the addition made to the total cost by the production of an additional unit of output. So marginal cost, always we have to remember that it is an addition made to the total cost by the production of an additional unit of output. Okay, so this is called as marginal cost. Then the next question, explain the law of diminishing marginal utility with the help of schedule and a neat label diagram. Okay. Question number 14. So always we have to remember that the law of diminishing marginal utility was given by Professor Alfred Marshall. Okay, it was given by Professor Alfred Marshall. Okay, and this law states that as more and more units of a commodity are consumed, the marginal utility derived from every additional unit, it declines. So as you consume more and more units of a commodity, the marginal utility, the satisfaction what you get, it goes on declining. Okay, so this is called as law of marginal utility. So you have to write down the definition as per given by Professor Alfred Marshall. So whenever you are writing, now this question is asked for 5 marks. Okay, so whenever you are going to write the 5 marks question, you have to write down who has given that definition, then you have to state its definition, and then law of diminishing marginal utility, it carries some assumptions, right? Then start with the assumptions. So what are the assumptions of this law of diminishing marginal utility? The first is income and taste of the income and taste of the consumer remains constant. So the income and taste is remain constant. Constant means same. Okay. Then units of commodity consumed should be homogeneous in product. Okay, should be identical. So there should be a homogeneous product. Homogeneous means whatever the units of commodity you are consuming, it should be the identical in size, nature, color, okay, taste, etc. Then whatever also the commodity what you are consuming, it should be of the suitable size. Okay, so basically you can say that it is of the homogeneous product. Okay, then the units of commodity should, right, the units of commodity should be consumed in quick succession. So if you want to achieve the marginal utility, then whatever you are consuming, no, it should be that the consumption should be continuous. Okay, consumption should be continuous. So then only you are going to achieve the law of marginal utility. Okay, law of diminishing marginal utility, because the consumption should be continuous. Okay, and the thing is, law of marginal, as more and more units of a commodity you are going to consume, your utility, your the satisfaction is going to go down. Okay, this is what your law of diminishing marginal utility is. So that's why in order to your satisfaction should go down, you have to continuously consume that particular commodity. Okay, so these are some of the assumptions what you have to take into consideration whenever you want to achieve that marginal law of diminishing marginal utility. So this was given by Professor Alfred Marshall. Okay, then since after writing the assumptions, you have to move to the schedule. So schedule is very important, and after schedule you have to go to the diagram. So schedule, I'll be drawing over here. So units, total utility and marginal utility. Units like till 6 will take 1, 2, 3, 4, 5 and 6. Then total utility 10, 18, 23, 25, 25, 23. Then the first one, it remains same. Okay, then after consuming the second, it goes down. Then here it comes to 0. then it is minus 2. Okay, so this you have to calculate. So first remains same, then it becomes 8. Okay, so marginal utility, as you go on consuming the more units, your marginal utility will go down and it can also become negative. Okay, so which are the things important over here? The negative one, and when it strikes to 0, and the first one, the when you consume the first commodity, that time your marginal utility is increasing, then it goes down, then again it goes down, then after when you consume the fourth one, that time this should happen during the continuous intervals. Okay, as I told over here in the assumption. So continuously we should consume the commodity. Okay, this should be continuous. Then after drawing the schedule, you have to go to the diagram. You have to draw the graph. You have to show the so here I am taking the units and here I am taking the marginal utility. So marginal utility I'll take from this 2 to 10. Okay, so 2, then units we took it as 1, 2, 3, 4, 5 and 6. So this is x axis and this is y axis. Okay, this is also you have to mark. Then at unit 1 we got 10 marginal utility, so 10. Then at unit 2 we got 8. Then at unit 3 we got 5. Then at unit 4 we got 2. Then at unit 5 we got 0, and at unit 6 it went to minus 2. So since my negative is there, I'll write over here as minus 1, minus 2. So it is going down. So what is happening, as you are consuming more and more units of commodity, your marginal utility is going down. Okay, so this is how you have to show the diagram. After drawing the schedule, you draw the diagram and then you explain the full diagram. Okay, now what is given in the above diagram? Units of the commodity are shown on x-axis and marginal utility is shown on y-axis. Okay, then you have to state that the diagram shows that the diagram shows that marginal utility goes on decreasing. Okay, the marginal utility goes on decreasing as more and more units of consumption, utility goes on decreasing with an increase in consumption. Okay, with an increase in consumption. So also I have to state that now what has happened when the fifth unit of commodity was consumed, that time your marginal utility was 0. So you have to state that when the fifth unit of commodity was consumed, that time the marginal utility became 0, and then when one more additional unit was consumed, that time it came to the negative. Okay, so but when the sixth unit is consumed, marginal utility becomes negative. So this is how you have to state the full schedule and the diagram. Okay, then we'll move to the next question. Question number 15. Explain the law of demand with the help of schedule and a neat label diagram. So law of demand, question number 15. So law of demand was also given by Professor Alfred Marshall. Law of demand was given by Professor Alfred Marshall. Okay, so according to the Alfred Marshall, what he states that the law of demand states that all the other thing it remains constant. Okay, so more quantity is demanded, at a lower price, and less quantity is demanded at a higher price. So more quantity is demanded at lower price and less quantity is demanded less quantity is demanded at higher price. Okay, so law of demand has an inverse relation between price and quantity demanded. So this is important. There is an inverse relationship between price and quantity demanded. Okay, so after this you have to write down the assumptions. So what are the different assumptions for the law of demand? The first one, the law of demand assumes that the law of demand assumes that the size of the population remains same. Okay, then next it also assume that the people in a country remains same. Okay, remains same. Then also the law of demand assumes that the related goods, okay, related goods, it do not change. So these are the assumptions what you have to remember. Then you have to draw the diagram, that is price and quantity demanded, because there is a inverse relation between price and quantity demanded. So you have to draw the schedule, price and quantity demanded. So price I am taking 1, 2, 3, 4 and 5. Quantity demanded 5, 4, 3, 2, 1. Okay. Then after drawing the schedule, you have to draw the diagram. The diagram I'll draw with this side. So, x-axis and y-axis. Here I am taking the price. So prices are shown on y-axis and quantity demanded is shown on x-axis. Okay. So this is 0, 1, 2, 3, 4, 5. Okay. Now, so as the price is 1, how much is the quantity demanded? As the price is low, demand is more for the particular commodity. Okay, as the price is 1, demand is 5. As the price is 2, demand is 4. As the price is 3, demand is also it's same. Okay, as the price is 4, demand is 2. As the price is 5, demand is 1. So what does this law of demand states that, see, as the prices of the commodity are increasing, the demand for the particular commodity is decreasing. Okay, so as we can see here, the price of the commodity rises. So the how much is the demand? The demand is less. Yes, here the price of the commodity is decreasing, so the demand is more. So this happens in the market. Yes, when the price of the commodity is less, that time we intend to buy more, and when the price of the commodity is higher, that time the demand in the market is less. Okay, and what happened when the prices are 3, that time the demand is constant. Okay, so this is how you have to explain the full schedule. Okay, then so in the above diagram, price is measured on y-axis, quantity demand is measured on x-axis. So on the x and this diagram, TD is this is the demand curve what we got. Okay, DD is the demand curve. So what does this diagram shows, that there is an inverse relationship between the price and the quantity demanded. Okay, so as the price, this also you have to explain, as the price is increasing, quantity demanded is decreasing. As the price is decreasing, quantity demanded is increasing. Okay, and when the price is 3, the quantity demand is constant. Okay, like this you have to explain the full schedule. Okay, then the next question is, explain 5 features of perfect competition which came for 5 marks. So the features of perfect competition. The first feature, perfect competition, uh, here is that there are different forms of market na, perfect competition, monopolistic competition, then oligopoly competition. So there are different forms of market structure. So perfect competition, in perfect competition there are large number of buyers and sellers. So this you have to remember. So the first feature is there are large number of buyers and sellers. Okay, large number of buyers and sellers. Then second one is they sell, now this large number of buyers, this large number of sellers, they sell some identical products. Okay, they sell the identical products. Identical products in the sense the homogeneous products, like it should be similar in size, then the all the features, the taste, then the shape, the color, everything is same. Okay, so we can say it as a homogeneous product. Okay, then um, all the buyers has got a perfect knowledge about market conditions here. Since there are large number of sellers over here, they sell the homogeneous product, right? So the buyers, they are fully aware about the prices, okay, and they are aware about the what are the different the situations that are going to happen when they are going to buy from the perfect competition. So large number of buyers, they got some knowledge about the market conditions. Okay, so perfect knowledge about the market condition. Also the seller has got the perfect knowledge about the market conditions. Okay, so perfect knowledge of market conditions. Then the fourth one is freedom of entry and exit. Freedom of entry and exit. So this happens in perfect competition, like any seller can come anytime and they can enter into the market and they can exit into the market, but this do not happen in case of monopoly. Okay, monopoly has got some restrictions with regards to entry and exit. Okay, then the fifth one is perfect mobility. So factors of productions, which are the different factors of production: land, labor, capital, enterprise. These are the different factors of production. Okay, and they have got a perfect mobility, like they can move, they will move to that industry where they get the best price. Okay, in the long run, a uniform market price will prevail in the market. Okay, so these are some of the features of perfect competition. There is large number of buyers and sellers, then identical products, perfect knowledge of market condition, then freedom of entry and exit. Okay, then the next is explain 5 features of monopolistic competition. So features of monopolistic competition. Okay, so different features of monopolistic competition is product differentiation. The first is product differentiation. Then second one is selling cost. Then lack of perfect knowledge. Next, freedom of entry and exit. Freedom of entry and exit. Then large number of sellers. So product differentiation is the first point over here with regards to monopolistic competition. So here there is a distinct product differentiation in the case of monopolistic competition. A product is often differentiated by its the size or the brand name, or they can put its own trademark. So this is what a product differentiation is. Product also, they can differ in color, they can color in its quality, the shape, whatever the size they are putting for the particular product. So this is product differentiation. Then the selling cost. Then selling cost, in the sense they are spending much on the advertisement. So each and every firm, they have to spend something on the advertisement cost, right? If each firm has to spend a lot on the advertisement of its product, so why they are going to sell, why they are going to spend more on its advertisement? Because they are going to get more profit out of it, and by doing this, by doing the advertisement, they are going to sell more units of the particular commodity. Okay, so and also advertisement will give them a wide range of publicity. Yes, so this is why in selling cost is one of the features of monopolistic competition. Then lack of perfect knowledge. Here there is a lack of perfect knowledge with regards to sellers and buyers. Okay, so sellers and buyers of the products, and the owners of factors of production. As I told, factors of production includes land, labor, capital, enterprise. They do not have a perfect knowledge about the market and the market prices. Okay, why do they don't have any perfect knowledge about the market and the market prices? Is because of the product differentiation. So each and every firm, they are going to sell its own differentiated product at their own different prices, right? So there is a huge competition over here, and no one is aware about the price of the particular product. Okay, then the next is freedom of entry and exit. So there is a freedom, as a new firm can enter and exit the market anytime, whenever they want. Also the old firms, whenever they want to leave, they can leave the market. Okay, so this is what freedom of entry and exit is with regards to monopolistic competition. Then the fifth point is there are large number of sellers over here. So in this form of market monopolistic competition, there are a large number of sellers, and no individual seller can influence its own prices in the market. Okay, so the firm is the price taker. We have to say price taker. The firm is the price taker over here. Okay, so this is what the features of monopolistic competition is. Then we'll move to the section B, that is the some cautions. So the first one is unilateral payments for which no productive services are rendered, like scholarship, old age pension. These are called as transfer payments. Okay, so these are called as unilateral payments wherein no productive services are rendered, like scholarship, old age pension, nothing is given. So it is called as transfer payment. Then the ratio of change in the ratio of change in saving to change in income is called marginal propensity to save. Then the sum total of expenditure on the domestically produced goods and services during the period of an accounting year is aggregate demand. Okay, then deposits which arise on account of loans by the banks to the people are called as secondary deposits. So the deposits which arise on account of loan by the bank to the people are called as secondary deposits. Then question number 21. When the exchange rate changes from $1 to is equal to rupees 60 to $1 is equal to rupees 70, India's export to USA will. What will happen to the India's export to the USA? Whether it is going to decrease or constant, or increase or diminish. So now the exchange rate is going to increase from 1 to 60 now earlier, and now it is going to increase from 1 to 70. So export is going, of course it is going to be increase. Okay, then State whether the following items are to be included or not to be included in the measurement of national income. So when we measure the national income, we have to remember that okay, when we take the national income, we have to remember what are the things to be included, like the old age pension scholarship or the second hand machineries or second hand goods are not taken into consideration. Then also the gambling amount are not taken into consideration when they calculate the national income. Okay, so the question is this question is for 2 marks, and they have asked state whether the following items are to be included or not to be included in the measurement. So the first one is, how many questions? There are total 4 questions over here. Mr. Ramesh purchased a new house for rupees 15 lakhs. So this to be included. Then, on account of the sale and purchase of a second-hand car, Mr. Narayan earned a commission of 20,000. This is of second-hand, so we are not including. So this is not to be included. Okay. Then Mr. Soham earned 10,000 by way of gambling. So as I told, this gambling amount and the second-hand amount should not to be included. So this will come as not included. Okay. Then Reshma received rupees 1 lakh as assistance by government under Ladli Lakshmi scheme. This is to be included. Okay. So this is how they can ask the question with regards to national income. Then moving to the next question, what is meant by the following? Balanced budget and the primary deficit. So budget, as we have seen, there are different types of budget, and budget is a statement of the income and the expenditure of the government. Okay, so balanced budget is that budget wherein your government receipts and government expenditure are equal to each other. Okay, so whatever they are receiving, and there are no surplus, there is no deficit. Okay, so this is called as balanced budget. Okay. So balanced budget, it is that type of budget which government receipt. Question number 24. Government receipts are equal to government receipts are equal to government expenditure. Okay, so this is called as balance budget. Then the next is primary deficit. So primary deficit is total revenue minus total expenditure and this total expenditure, it excludes the interest payment on debt. Okay, so this is called as primary deficit. So it is a difference between the fiscal deficit and the previous year interest. Okay, interest payment of the government. So it is the difference between fiscal deficit and the previous year interest payments and the previous year interest payment of the government. So these are the questions which are very important. Okay, then we'll move to only to the important questions. Okay. The next question is question number 26. Involuntary unemployment, fiscal policy, the saving function. Okay. Involuntary unemployment, okay. So unemployment unemployment is classified as a different type, involuntary unemployment. So involuntary unemployment, it refers to the situation individual where an individual is not working. Here the individual is not working, but they are willing to work, okay, and they are seeking for the employment. Where an individual is not working, but they want to work, and they are seeking for employment. So this is involuntary unemployment. So in voluntary unemployment, we learned that an individual who is not working, okay, and but they want to work and they are seeking for employment. So those the adults who are seeking for the employment, they come under this category, that is involuntary unemployment. Okay. Then the next question is fiscal policy. So fiscal policy is the government spending and the taxes to influence the economy. So this is fiscal policy. So it is the use of government, we can say it is a use of government spending and taxes of uh, taxes to influence the economy. So this is called as fiscal policy. Then there are different tools of fiscal policy. As we saw, transfer payment for the first MCQ, unilateral payments. So there are tools of fiscal policy. The first tool is government spending, then taxation and transfer payment. Okay, so this is fiscal policy. It is a use of government spending and taxes to influence the economy. Okay, then next is saving function. The saving function. Okay, saving function. So saving function, or the propensity to save, it expresses the expresses the relation between saving and the level of income. So it shows us the relation between how much is your saving and how much is the income. Okay, so it expresses the relation between saving and the level of income. Okay, so this is called as saving function. Then we'll move to the next question. What is meant by the following? The first one is bank rate. So it is that rate at which it is that rate at which the central bank of a country gives loan to the commercial bank. It is that rate where central bank, that is RBI, gives the loan to the commercial bank. So central bank gives loan to commercial bank. So this is called as bank rate. Then the next is open market operation. So what do you mean by open market operation? It refers to the purchase and sale of the government securities. Okay, so here there is a buying and selling of government securities. So it is called as open market operation. Then margin requirement. So margin requirement is nothing but, you only have to understand that it is the difference between market value of the security offered by the borrower against a loan and the amount of loan granted. So this is called as margin requirement. Then question number 28. Then only this questions. So state the motives of holding money in the following situation. So there are different motives of holding money. There are speculative motive, transactionary motive, okay, precautionary motive. So first question is, Rohan is a trader who has a liquidity preference so that he can invest his money in bonds when the interest on bond is high and the price of bonds are low. So this is with regards to the bonds, the securities. So this is called as speculative motive. Speculative motive. So that deals with the speculations in the market. Then the next question is, Vimal's mother keep aside 10,000 in cash to meet the unforeseen circumstances. So this is called as, so it means that she is taking some precautions to meet some uncertainties. So this is called as precautionary motive. Then the next is, Rahul's father keep aside 20,000 for a day-to-day expenditure of his family. So when it is for day-to-day expenditure, it is transactionary motive. Okay. It is for day-to-day expenditure. So these are the three motives of holding money, that is speculative, precautionary motive and transactionary motive. Then the next question, explain three functions of the central bank. So central bank is the RBI. So what are the functions of the central bank? First, it is the apex bank. Then apex bank, it controls all the other commercial bank. Then it acts as a lender of last resort. Then it acts as a banker's bank. Okay, lender of last resort. So only three functions they have told to write for 3 marks. So you can write whichever is easy for you. So since central bank controls the commercial bank and it it is the one, RBI is Reserve Bank of India is the apex bank. Then it is the bankers bank, and it is a lender of last resort. If the commercial bank they do not have money, then they approach to the central bank. Okay. Then explain three functions of money. Different functions of money are as follows. Functions of money. So money act as a medium of exchange. So money act as a medium of exchange. So first, this is the first function. So money act as a medium of exchange. Money by itself, it do not have any utility, and through money we can since it is a medium of exchange, we can exchange the goods okay, or services, okay, and it has got some and specialization, it increases the productivity and efficiency, okay. So this is the first function. The second function is measure of value. So money is a common measure of value for goods and services. So money is used as a measuring the means by which the value of other commodities are expressed. So values of commodities are expressed over here. This is the main point. Then third one is store value. Store of value. Store of value, it means money functions as a store of value, and we have money we can store in the form of credit cards, or we can store it in the bank. So we have seen that money is convenient form of form to store, okay. So it implies that the purchasing power can be shifted from the present to the future. So these are some of the functions of money. Other functions include transfer of value and standard of deferred payment. So here they only ask the three functions. Then we'll move to the next question. Explain the circular flow of national income with the help of neat label diagram. So with regards to circular flow of national income, here we have to understand this with regards to the diagram. So in the circular flow of national income, there are producers, or we can say firms, and there are household. So household, what they give to the producer, they give the factor services. Now which are the factor services? Like land, labor, capital, enterprise, okay. So factor services, they give the factor services like land, labor, capital, enterprise. So this is called as real flow, okay. And in return, producers or the firms, what they give to the household, they give goods and services. So this is also a real flow. Then again, household, again there is a factor payments over here. Factor payments goes from producers to the firm, producers to the household, okay. Producers or firms to the household, and this includes rent, wages, interest, profit, okay. So this is factor payment. And household, what they do, they in return they consume. So there is a consumption expenditure over here. So it is called as money flow, okay. So now what does this diagram states that? So here we only consider a simple economy, that is of producers and of household, okay. That is producing sectors or the firms and the household. So there is and here they assume that there is no government intervention, okay. So this is one assumption here, no government. So and also there is no rest of the world sector. So household, these are the owners of the factors of production like land, labor, capital, enterprise. Okay, and they supply these factors to the producer firm. And then the firms, these are the manufacturer, no, or the producers. They produce goods and services and they give it to the household. Okay, then this is how there is a circular flow of national income. Here you have to state more theory part. Okay, and this diagram you have to draw. Okay, then the next is explain the situation of excess demand with the help of neat label diagram. So excess demand here refers to the situation where aggregate demand is in the there is a aggregate demand is more as compared to the aggregate supply. So aggregate demand is more than aggregate supply. Aggregate demand is more than the aggregate supply. So now this has I'll explain this with the help of the diagram. So here we got aggregate demand, and here we got the income or output. So it means that here so here we have to draw the expenditure line also. So ADE and ADF and the point where our expenditure and ADF line meets is your equilibrium. Okay, so here it has shown some excess demand. So this is the situation of excess demand. Okay, so in this diagram we can see that ADF, it indicates full employment. So this curve, it shows that there is a full employment level of aggregate demand. Then ADE is the desired AD in excess. So because this is excess demand is more over here, the difference between this ADE and ADF is the point EF. Okay, the difference between these two is the point E to F, which shows the excess demand. So now excess demand is the situation where your aggregate demand is more than aggregate supply, and this can be interpreted in the following ways, that desired AD, aggregate demand in the economy, it happens to exceed over here, and happens when its full employment in the economy happens to exit its excess in its full employment level of aggregate demand. Since resources have already been fully utilized and therefore aggregate supply, it cannot be raised, demand only puts a greater pressure on the available goods and services in the economy. So accordingly to this, price rises. So since there is a more expenditure, there is a excess in demand over here. Okay, so this is how you can draw the diagram of excess demand, and you have to state the explanation of this particular access to demand. Okay, then the next question is, explain 5 types of non-tax receipt. Which are the different types? Now tax receipts are classified as tax and non-tax receipts. Tax receipts are your direct taxes, that is your wealth tax, income tax. Okay, progressive and the regressive tax also comes over here. Your non-tax receipts includes all your indirect taxes. Like, which are the different indirect taxes we have got? We have got SG, special assessment, third one fees, fines, income from public enterprise, so these are your different non-tax receipts. So SG is nothing but a property left out without a legal heir. Then special assessment is another source of non-tax receipts in which in which it is made by the owners of those properties whose value has appreciated. Property's value has appreciated. Then fees are like the birth registration fees, the land registration fees, which are given for the government for rendering the services. Then fines are for the legal actions, like when we break some rules and regulation, that time a legal action is taken on us, so that's why we pay the fine, and this is one sort of non-tax receipt. Then income from public enterprises is profit from, which are the different public enterprises, like we have got railways, we have got Indian Oil. So whatever the profit they make in here in public enterprises, this is all comes under non-tax sources. Okay, or non-tax receipts. Okay, these are the non-tax revenue receipts of the government. So there are different types of receipts, that is tax and non-tax receipts. Okay, then the next question is, explain the components of the balance of payment. So components of balance of payment includes, so balance of payment components includes, the first one is current account, So this includes export and import of goods or the visible items. So this is one of the component, and it includes export and import of goods or of visible item. So export or import of goods. Then next, current account also includes export and import of services. Export and import of services. Then third, it includes all the unilateral transfers like scholarship, then old age pension fund. So unilateral transfers. So this is the first component of balance of payment account. First is current account, and then we have got the next is capital account. Okay, so capital account includes foreign investment, so foreign investment has two sub-components, that is the first one foreign direct investment and the portfolio investment. Foreign direct investment, it refers to the purchase of asset in the rest of the world, and they have got control of that particular asset. Okay, so FDI, foreign direct investment, and then we got portfolio investment. So portfolio investment, it refers to the purchase of asset in the rest of the world without any control. So in portfolio investment, there is no control, and here control over the asset. Then the second one with regards to capital account is loans or borrowings. So loans and borrowings again has got a two sub components, that is commercial borrowings Commercial borrowings, it refers to the borrowing by a country from the international money market, and second one is borrowing as external assistance. So it refers to a borrowing by a country with consideration of the financial assistance which is given to the particular country, and the interest rates are lower over here, lower interest rates. Okay, so this is called as components of balance of payment. So it includes current account and the capital account. Current account includes export and import of goods and services, and all the unilateral transfers like scholarship, and old age pension. Then capital account includes foreign investment, which includes FDI. It controls over the all over the asset. Then in portfolio investment, there is no control. And second, in loans or borrowings, which is a part of a capital account, it includes commercial borrowings of the particular country. Then it also includes borrowing as external assistance, which got a lower interest rate. Okay, so this is the last question. So in this we saw which are the different types of non-tax receipt, the situation of excess demand, then circular flow of national income, then we saw which are the different functions of money, fiscal policy, then what are primary deficit, features of perfect and the monopolistic, law of demand, then law of marginal utility. So here these are the main things which are important. So okay. Then also we saw the fill in the blanks with regards to this unilateral transfer payment, then ratio of change in saving to change in income is called marginal propensity to save. Okay. Then we saw the meaning of law of demand, we saw the law of diminishing marginal utility, then total cost, average cost, marginal cost. Okay, then which are the different determinants of supply, what is cartel, is a formal agreement between the producers, okay, to avoid the competition or the conflict. Equilibrium price is the main maximum profit maximization. Then monopoly is a single seller wherein there is no product differentiation. Then we also saw normal goods, inferior goods, and what are the different substitute goods. Okay. So thank you for watching my video.